Christine Lagarde's recent comments are widely interpreted as a thinly veiled rebuke to Donald Trump's demand for the Federal Reserve to immediately lower interest rates. This intervention underscores a growing concern regarding the potential detrimental effects of political interference in the independent functioning of central banks. Lagarde, the president of the European Central Bank, ECB, explicitly warned that such political meddling could significantly destabilize the economy, potentially exacerbating inflation and creating a volatile market environment. Her statement served as a cautionary tale, highlighting the risks associated with compromising the autonomy of institutions responsible for managing monetary policy. Trump's persistent pressure on the Federal Reserve, echoing his previous confrontations with former Chairman Jerome Powell, has raised significant anxieties. There's a palpable fear that Powell might choose to resign under this sustained political pressure, a move that could send shockwaves through already fragile financial markets. The potential for a leadership vacuum at the helm of the U.S. Federal Reserve carries considerable weight given its global influence on financial stability. The uncertainty surrounding Powell's future underscores the precarious balance between political accountability and the necessary independence of central banking institutions. The repercussions of a politically influenced Fed decision could extend far beyond U.S. borders, impacting global economic stability. The situation in Turkey provides a stark illustration of the potential consequences of unchecked political interference in monetary policy. Turkey has witnessed a troubling pattern of central bank governors being either dismissed or resigning in recent years, often under circumstances suggesting political pressure. Last week's decision by the Turkish central bank to lower interest rates, despite inflation soaring above 40%, fueled speculation of government interference. This decision, seemingly made against the recommendations of sound economic principles, further solidified concerns about the erosion of the central bank's independence and its potential negative impact on the Turkish economy. The ramifications of such actions are far-reaching, impacting investor confidence and long-term economic growth. The UK's recent experience also offers a cautionary example. Former Prime Minister Liz Truss's criticism of the Bank of England for its perceived failure to anticipate the market turmoil following her mini-budget highlights a broader trend of attempts to undermine the independence of central banks. Truss's accusation of the Bank of England being part of the deep state, restricting government policymaking, reflects a dangerous disregard for the crucial role of independent institutions in maintaining macroeconomic stability. Such rhetoric not only undermines the credibility of these institutions, but also creates uncertainty and instability in financial markets. The implications for economic governance are significant, posing a challenge to the long-held principles of independent central banking. The international community closely observes these trends, recognizing the potential for a domino effect, undermining the global financial system's stability. Maintaining the independence of central banks is paramount for fostering confidence, attracting investment, and ensuring long-term economic prosperity. The actions of political leaders have significant and far-reaching consequences on the global economy.